From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday the 13th, 2026. Let's start off with the Shamrock Club's 50th annual St. Patrick's Day Parade. It kicks off Saturday at noon from West Wisconsin Avenue to Water Street. You know the drill, wear and drink something green. Your Milwaukee Brewers are still in Arizona, winding down the last 2 weeks of spring training. And your Bucks have a couple of home games this week. The Pacers are here Sunday, and the Cavs are in town on Tuesday. Let's start off with some fun stuff. The annual Camel Beauty Pageant in Oman. As usual, it has been plunged into chaos. 20 camels were disqualified, and the owners have been accused of cheating. How are they cheating? By artificially enhancing the camel's features using silicone to inflate their humps, and Botox gives them those pouty lips. Okay, stop the presses. Buffalo Wild Wings unveils a wing-flavored protein espresso martini. They call it a proteini because it adds 10 grams of protein. Yeah, but how much vodka does it have? And finally, a 50-year-old woman from India was declared dead, and the family was preparing for a cremation, but a huge pothole turned out to be a lifesaver. The hearse hit a pothole, and it jarred her back to life. Think of how many lives we could save right here in the streets of Milwaukee. On the podcast today, we have Dave Sandstrom, John Sandstrom, Joel Driesing, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Markets hit a few potholes this week. The Nasdaq down 1.3%, 282 points down on the week. The S&P down 1.6, that's down 108. And the Dow Jones Industrial Average lost 2% this week, closing at 46,560 on Friday. For the year, Nasdaq now down 4.8%, the S&P down 3%, and the Dow Jones Industrial Average down 2.9%. Dave, in reading the closing numbers for the week, it's hard not to, I think, feel some sense of desire to want to act. It's hard not to look at the market volatility and go, hey, what should I be doing differently? And I think clients are probably seeing some prompts from certain places that maybe there is something they should do. What are you hearing from clients?
Well, Kyle, I certainly don't want to minimize the volatility and the feeling that it gives most people as they look at their portfolios going in the wrong direction. I certainly don't enjoy this type of action in the markets either. But it does bring up a very serious issue and a very important point to make at this point in time. There are millions of articles that are going to appear on the internet, on the news, from your neighbors, and maybe even that cousin that calls you and tells you what to do with your portfolio. I'd be very careful in making knee-jerk reactions. Going in and making wholesale changes, panic moves, selling your stock portfolio, just in reacting to what's going on in the short term can cause you harm that will be difficult to overcome in the long run. Your portfolio, if it's balanced appropriately, you've already made the proper moves to protect yourself. I think that's the important thing to take away from this. Know that going in, if you've appropriately allocated your portfolio, you have already anticipated this problem. And now you want to start looking forward to, okay, where does it go from here? If things get down much further, if you look, and maybe there are some opportunities if equities get priced low enough to maybe go the other direction and actually start buying something on sale. But knee-jerk reactions, reacting to articles that are written on the daily newspaper and blogs is not a good thing to do.
Well, and of course, Dave, I think it's important to point out that our job and our responsibilities are drastically different than those of someone writing one of those articles. That if you're looking to capture readers' eyes, if you're looking to get them coming back tomorrow to see what the next thing they're supposed to respond to is, you may write a very different article than if your job is to help clients through these difficult times. Not, again, to respond to all of the unease, all of the uncertainty, but to have a real conversation about what the client's objectives are and what they're trying to accomplish. which is vastly, vastly different than the response to a single article, a single newsline, a single headline. And so I do think it's important to point out that for many of our clients, we've spent the better part of the last 2 years talking about all the things that could go wrong, and often looking somewhat foolish in doing so because it was the middle of a very strong run for the stock market. And I think it is the nature of being an investor that when everyone else is screaming about how bad it hurts, our job sometimes is to go in and say, but okay, here's some of the reasons why we're going to stick to the plan. And when everybody else is screaming about how great things are, sometimes it's our job to say, yeah, but let's avoid being too overly optimistic here because there are some things that could go wrong. And we're certainly seeing that right now. I think it's tough as an investor to look at the world as we see it today and go, well, yeah, but look at all the things that could come from this down the road. But I think it is that important reminder that there is still good stuff happening. There is still development. There is still productivity growth. There are all of these things that make us want to be investors. And you don't just abandon that because of that one headline or that one problem that's out there. And then perhaps, John, on the other side, there are some things that we had been more cautious about that we've been rightfully cautious about. And some of what we've seen recently has led to some pretty significant pain. And I'm thinking specifically of things like the private credit marketplace, where a lot of investors were told, hey, this is the next great opportunity. This is what all the ultra wealthy are doing with their money, and you should pile on in. And now we're seeing potentially some cracks forming along that part of the world.
Yeah, and this is a perfect example of why it's really important to really understand what the investment is before you start getting all excited about that particular investment. Essentially, private credit, which you've probably seen a million articles this week about like you said, the cracks that are starting to develop there. But essentially, these private credit funds, you get, a manager or a lead investor who pools the money together, and essentially, and you don't even necessarily know what the money is going to when you invest initially, if you're one of the initial investors. Essentially, the money is then loaned out to distressed companies usually who need loans, who can't necessarily secure loans from the public markets or banks, and that's why it's attractive to institutional investors, higher yields and stuff like that. But typically that means that it's not as high of a quality of a loan, and that's what we're starting to see. Some of those cracks this week. You see articles about people not being able to take their money out, withdrawals being capped based off of the quality of the underlying loans starting to degrade, and the fact that this kind of stuff is offered recently to just the general retail investor is that's part of the reason why we stay away from that kind of stuff.
And those liquidity issues that I think are so critical to understand as an investor. I like the idea that knowing the price might go up and down, but if I want my money back, I can sell this and I can get whatever the value is on the day I sell it. And one of the problems that we saw with private credit was even in the case where you were willing to accept that it was down 40%, it didn't necessarily mean even then that you could sell and get your money back. Right, John?
Yeah, I mean, some of these funds were capping any withdrawals, 6 months, 12 months at a time. A lot of these loans are structured where if you put your money in, you are expected to be committing your capital for 7 to 10 years on average. And if you start to see some weakness in the underlying loans, it doesn't mean that you can just change what your initial investment was and say, hey, I'm taking all my money out.
I think it's real important lesson here is that if something sounds like it's too good to be true, I would go and kick the tires a couple extra times, because in investing, there is no magic pill or no magic idea that is suddenly going to pay you outsized returns for less risk. Risk is rewarded in the markets, and if something is going to pay you in excess of double-digit returns, it is not risk-free. And that's I think a lot of these funds were portrayed as something more like a bond, a high-quality investment, and they had very, very attractive returns. And I don't think the average retail investor, John, like you said, really understood what the risks were.
I think early on in these conversations going back 6 months or a year, we talked about this a bit on the podcast, and I was at the time much more skeptical that the point of what was happening for public investors in creating these private vehicles was that we were trying to offload some of the really high-risk stuff that maybe the rest of the market didn't want and do it to investors that maybe didn't better understand it or couldn't better understand it. And a lot of what we saw was some of these big companies trying to push this stuff into 401ks to investors that largely are disengaged from their underlying retirement funds, that largely are just relying on what they're told by the 401k sponsor is the way they should allocate. And so it is interesting to me that this was pushed more than it was something that people were pulling towards themselves. They were told they wanted it. They weren't clamoring for it. And I think it's interesting that we're seeing exactly what I feared would happen. Now, that said, there are still some great products out there. There are still some things that I think have some worth. It's not like this is suddenly the end of that space. It's not like this is suddenly you shouldn't ever do any of this, but you do need to understand, John, you pointed out, you got to understand what it is you have. You do need to understand what you're investing in and why, and it has to fit in with your bigger picture objectives. Joel, we had all kinds of economic data this week, a lot ahead of a Fed meeting next week, and I think a lot of eyes on that data as we try to navigate a war in Iran, as we try to navigate what's the Federal Reserve going to do in response to these spiking oil prices. I'm not sure we got a ton more clarity, but we certainly got more data.
We did, and the trouble with all the data is that it's old. There are things that have developed since the data came out, since it was reported, that are going to affect what the Fed is wanting to know about what's going on with the economy. We learned from an update on the gross domestic product that the economy is slowing more than we thought. It was initially said that the last 3 months of 2025 that the economy was growing at a 1.4% pace, and now we find that it's growing at a 0.7% pace. Part of that is the timeout that the government took when it shut down in October and part of November. But part of what we're seeing is a slowdown in consumer spending, and we keep reminding people that consumer spending accounts for 70% of the economic growth in this country. So that's a little concerning. We also found out that inflation has remained stubborn. It's still, above what the Fed target is. The Fed target of 2% hasn't been that low since, I think, 2021. And it's still, the last numbers we have today from the Bureau of Economic Analysis is that the year-to-year inflation rate is 2.8%. That's down from 2.9% in December. It was 2.8% in January, but it's still above that 2% mark, and that's something that the Fed has to look at. And the Fed's also concerned about the labor market, and I've seen this referred to in several places as a low fire labor market. So we had numbers today looking at job openings, and they're basically staying below where they were in February of 2020 before the COVID pandemic started, which was near a record high at the time, but it shot way up after COVID, and it's been below that pre-COVID mark now for 3 months in a row. So there's not a lot of new jobs that are being offered. That's pretty stagnant right now. And at the same time, we week after week look at the unemployment claims numbers, and those are at record lows. I mean, they're 41% below what the average has been since 1967. So there aren't a lot of employers are reluctant to hire, but they're also reluctant to let workers go.
And I think that makes some sense given all the uncertainty that's out there. But I think it also has influenced what the market believes the Fed's going to do next week. I think it certainly has allowed rates more broadly to move a bit higher. Now with this expectation that inflation is again the bigger problem. We went through a kind of narrow window where we were a little more concerned about the labor market, and we thought, okay, maybe the Fed will finally pivot to focusing more on labor and growth than just strictly on inflation. But with a spike in oil prices, with some higher inflation, CPI and PCE prints, I think it's clear that the Fed is going to continue to focus on the things they have to focus on to get that under control, as long as the labor data that we're looking at, the unemployment claims, the job openings, the quits, those kinds of things that all piece together into, okay, how healthy really is the labor market, as long as those are strong enough. And I think that's largely been the answer, right, is it's maybe not as healthy as it was. It is still strong enough for this economy, and so we have to be more concerned about it.
And there are still some questions about how reliable the data are because we weren't collecting any data in October and November. So there are pieces that are missing that economists wanted to have in place to have a better picture even now of what's going on.
And we got a lot of housing data this week, a pretty popular bill coming through the Senate right now and trying to get big money out of the housing market, and we'll see where that goes. But at least with what we can see right now, some mixed signals in the housing market.
And some of those proposals are looking at trying to put more supply out there, and that's really what seems to be missing. And one of the numbers that came out that I look at was with the housing starts and the building permits numbers, was just looking long-term at the total number of houses that are under construction, which reached a record high in October of 2022, but it's down 26% since then, and it keeps going down. And that's important because, and I'll put this chart on with the show notes that we run with the podcast, but you'll see that it just dropped off to nothing, basically, after the Great Recession, and it still hasn't gotten back to where that was. I mean, it shot up after the pandemic, but it's now going back down again, and it's going to take years to get back to the level that we need to be.
Yeah, Joel, and I think, even with this bill on the table about maybe moving some of the big money out of the housing market, I'm not so sure that's the panacea that some people think it is. I think that, to your point, it's the availability of inventory, which was really created by a post-pandemic influx of money, zero interest rates for so long, and we have locked in millions of mortgages in this country in the 2% range. Those customers that hold those mortgages are going to be unwilling for a long time to let those go, and I think that's restricting inventory.
Dave, the National Association of Realtors came out this week with existing home sales numbers, and they're still near 30-year lows. One of the things that they were pointing out was that the affordability of housing is about the best it's been since March of 2022, so in 4 years. But part of that is mortgage rates. Mortgage rates crept below the magic 6% mark just before the war in Iran. Now, this week, it's back above 6. It's 6.11%, I think, this week.
And such a critical part of the affordability issue, right, is that mortgage rate. It's what a lot of people have pointed to recently. I'd add that housing prices have come up pretty substantially. And we did get some news in the existing home sales numbers that at least it feels now like maybe they're not increasing at quite the same rate, especially with respect to wage growth.
But they're still increasing. Yes, yeah, and the increase is below what the wage increases have been, but 32 consecutive months, the year-to-year cost of median cost of a house has gone up.
And then maybe a more forward-looking indicator at the end of the week in consumer sentiment and an idea on kind of, hey, how do we really feel about what's going on? Some of that data was obviously before all the madness started in Iran. Some of it has come since. And so I'm not sure it's a great approximation just yet of what things look like, but it's something we certainly look at.
Consumer sentiment is fickle. You always take it with a grain of salt, but it is something that economists look at. And the University of Michigan does this consumer sentiment survey, comes out twice a month. And what they found was they did about half of their surveys before February 28th, before the war started, and then the other half they did after the war started. And those first surveys, people were saying, yeah, I'm actually feeling a little better about where my personal finances will be and inflation will be. And it just took an opposite direction as soon as the war started.
And understandably so. I think, we look at our portfolios, we look at the world around us, we look at the price of a gallon of gas, and all of that influences how we feel. Of course, we have to be careful, as we talked about early in the show. what we choose to react to, what headlines, what news, what emotions we choose to react to, because we have had a plan in place for this. We do know how we should respond, and we have decades of data that proves that those actions are the right actions, even if it doesn't always feel like it when we're in the midst of it. And so maybe not the most comforting thought when we're staring down a market that's still down a little bit on the year, that had a rough week. But I do think if you go back in time and look at what was the right approach to these kinds of environments, you're going to find that often staying the course is the best way to go. We enjoy doing the program for you. Thanks for listening. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.